All right. Thanks again, Mo. And it is my distinct pleasure to be with you here today to talk about my favorite topic, fixed income investing. But before we get into it, I do want to take just the briefest of moments to recall where we were 23 years ago and to remember those that fought so valiantly and lost on 9/11. And with that, let's move into it. I made a decision to entitle my presentation At Any Rate, because I do think fixed income is extraordinarily attractive. It's attractive for the savers and for those that are looking for income. But first, a little bit about Federated Hermes, the place that I've called home for the past 20 years. I'm at our office, which is headquartered in Pittsburgh, Pennsylvania, where we were founded over 50 years ago. We do have offices across the world, but most of our fixed income team is located here in Pittsburgh, as well as in London and Chicago. We do have a significant amount of assets under management in the liquidity and fixed income areas, with just over $580 billion in money funds. And then in fixed income, it's just shy of $100 billion. We do offer the complete suite of fixed income products and have specialists organized by team across these efforts. We do organize ourselves by the corporate bond team. That's the team that I was on most recently, and then government, high yield, international, and so on. So just about 100 investment professionals devoted to that area. But let's get into it. Let's look at the economy from a fixed income lens. And you see here a jet coming in for a landing. And we've been talking about this now for well over a year. Are we going to have a soft landing? Is it a question? Is it a statement? Or is it something that we're excited about? And really, when we're thinking through the economic releases and what the Federal Reserve is going to do, and even politics and policies, this is at the heart of the question right now. What is going to happen with the economy? But let's dig in on that a little bit. And let's maybe level set. This is a simple line chart. Where do we stand? Let's get everybody on the same page. This is a line chart of GDP going back to 2000. And it's not a contrived time period. It's not the longest time period, but I think it typifies where we are in terms of technology and different elements that makes it a realistic area to look at. When we look at this time period, we see the extraordinarily sharp movements back around 2008, the great financial crisis, and our last significant recession in this country. Tough to believe that true recession was that long ago. And then we see the extraordinary volatility around the pandemic period, where everything shut down and GDP cratered, and then how quickly it came roaring back. And that's really been a theme of my research, is how did that pandemic period and the ensuing shifts in supply demand across the world, and then even in our own attitudes and behaviors, is not just savers but spenders as well, influence where we are. Interestingly enough, the median over this time period is 2.4. The current measure of GDP for this current quarter that will end on September 30th is actually right about that same level, 2.45. And that's using a GDP Now estimate tracker reported as of last Thursday. So you can see over this time period, that's where growth has largely been. Again, the scale distorted by that pandemic period. But if you look closely between 0 and 10, we've been hovering about this 2.4 range for quite some time. See that one? There we go. It needs a heavier click. So second quarter, 2.8, first quarter, 1.4. You can see we've been really bouncing around since that pre-pandemic period, and that we've had different leaders toward what is building toward the GDP. And that speaks to why we've had some strength in the economy at times that perhaps has been somewhat less expected or not what we would have anticipated knowing about what the conditions as we do. But it speaks to that diversification and the strength. So when we're expecting recession, or what we're looking for in a very backward way, is that GDP would contract or move closer to zero and then south of zero into negative territory. But we all know during those first half of 2022, you see those negatives. But the NBER, which is the association that declares recession, usually by a pretty long look out in a rear view mirror, they did not declare that a recessionary period because they're also looking for other signals across spending, across employment, and general momentum in order to show that trend and call it a recession. So here's the current Fed funds rate and showing it all the way back to what we call the modern Fed era, going back to the 1970s. And I'm showing this chart again to highlight where we are. The upper limit right now is 5.5%. But you can see also over time, those shaded gray bars, those are recessionary periods. So it seems that if we look closely, when the Fed starts to move their rate down or gets mid-cycle, that's when we're most likely to have a recession because the Fed increases rates to slow down the economy, but then reduces rates ostensibly to get it back in gear, to give it a little bit of oomph. And now that's the precipice that we are facing with the Federal Reserve about to meet next week. They will meet on the 17th and 18th, and then at 2 p.m. on the 18th, we'll issue a press release that will give where the rate is and a little bit of a forward look, then followed by a press conference at 2:30, and we'll also get a couple of indicators from them at that time. We also look at what we call negative Treasury yield spreads. So that's the difference between a long rate and a short rate. And in most circumstances, and it stands to reason, if you're loaning somebody money, you would expect to get a higher coupon or rate or charge them more interest for a longer amount of time. But when the Federal Reserve increases rates pretty rapidly, the long end can't keep up. And we have what we call an inversion. So in this case, the 2-year Treasury was higher than the 10-year Treasury for an extensive amount of time. And in fact, it just normalized or uninverted in the last couple of weeks. However, the 10-year is only ahead of the 2-year by about 4 or 5 basis points at any point in time. So still relatively flat. We do expect that to continue to normalize, where the 2-year will be lower than the 10-year. And most definitely the 3-month rate will be lower than the 10-year going forward. We've been talking an awful lot about inflation, and the Fed has a dual role where they seek price stability and strengthen employment or a growing economy. So for the past couple of years, inflation has been at the forefront, and the Fed has defined their target as 2%. And that goes back to simply a setting of a target. They discussed a range, they discussed, 3%, but they've set it at 2% and they're likely to stay there. It's a goal, and it's not something that they necessarily have to meet in an absolute sense, month after month or year after year. It seems that directionally getting close will be good enough. And we are approaching that. We had a key statistic released just this morning, the CPI, and that came in within expectations at 0.2% on the headline, which reads 2.5% for the year on year. There were some stickier elements there, but still, all in all, I think we have to take a lap here for making significant progress from where we were in mid-2022. So inflation is coming down. Earlier on, during the zero interest rate period and after the great financial crisis, up until the pandemic, kind of loosely stated, we did see that inflation was running below 2%. I do think that there's enough broader factors like globalization and just shifts in the workforce and other elements that are broadly and slightly more inflationary, where I do expect us to live in this world between 2 to 3% inflation for the next several years or so. A key area of my research and something that I've really been watching is employment. And that's a statistic that is released every Friday morning and one that the market watches very, very closely. And this is data as of June 30th, but I'm going to bring us up to date. So about June 30th, we were at 4.1%, and we have ticked up every month since then. July 31st, we had some news out of Japan that was relatively weak. And then on Friday, August 2nd, we had kind of a stunner of a jobs report where the payrolls number, or the number of jobs added, was significantly less than expected. And this unemployment rate ticked up to 4.3%. Now I'm going to get super nerdy here because that was rounded up from 4.25%. And that's notable as this past Friday, that unemployment rate moved down to 4.22%. So when you're looking at it in headlines, it's going to read 4.3 versus 4.2, but generally still, compared to history, a very attractive unemployment rate, showing a relatively healthy jobs market. And then on the right, we have the change in total non-farm employees. That's usually the first number released. And we're seeing that kind of tick around a little bit. It has been disappointing. You can see June 206, but now we were down to 145 on Friday. And that was after a report of 114 on August 2nd. That's the stunner of a report that I spoke of. And that's what led the Fed to really set about a pretty strong dialogue that they will begin to reduce rates at their next meeting. Because they also, while they want to have inflation in check, they also want to provide for strong employment to the extent that they can. But the labor market has really shifted in this post-pandemic period. And you'll recall I mentioned that attitudes toward work have changed, but also work flexibility has changed an awful lot. And I think we're seeing an ebb and flow in those that decide if they want to work and how much they want to work. But you can see on the left that the labor supply still is below the demand. Those areas were farther apart coming out of the pandemic, and that's when we had some inflation related to wages resetting. But as those numbers come close together, we're reaching almost an equilibrium. And something I've been thinking about is right now, the feeling that we have, is this what equilibrium feels like in markets, right? Where you get a little bit of good information, a little bit of softer information, but a lot of yin and yang going on in markets. But on the right, we have the labor force participation rate. We're still not back up to that pre-pandemic number. And then the employment to population ratio. And to me, what that reflects is that really we're seeing fewer people in the workforce. And I think that that's part of the age wave. We do have that greatest generation, those born between 44 to 46 and 64 to 66, however you want to count it, often called the baby boomers, that are cycling through the workforce. And that generation has made a significant impact on every facet of our lives and lifestyle. So as they shift into moving away from work, and I'm not remotely ageist, but you're seeing it in the numbers, we simply do not have the population coming up behind to support the current work needs. So you're still seeing that separation, and that's why it's been a very difficult labor market to forecast. Here, I'm hammering home a point, but you're seeing that we just have fewer folks in that working age population and how that is expected to continue to decline. So that's a big difference, again, facing the labor population and also companies as they make decisions about what to do moving forward, is this rapid decline and shift in demographics. And then finally, talking about the broader economy and fixed income. It's important to remember the US federal deficit and debt. It has increased pretty dramatically and puts us in a different stead. We continue to be the reserve currency. We continue to be the market that folks will move to when there is a flight to safety. However, this is something that will need to be dealt with, not in the very near term, but probably moving out toward 2032. And I'm always remiss and don't really like to discuss politics, but they are at the forefront. Neither party, neither presidential candidate, nor any senator or House member that I know of has actually brought this to the table. We are in need of statesmen that will be willing to deal with this pending problem. And here it is again. The only favorable thing here is that interest rates are much lower than they have been historically, which makes the interest payments more manageable. But you can see that it is still definitely a growing problem that we will have to deal with. Let's get into fixed income a little bit. Let's take it back. That number on the far left is the current Fed funds rate. So you can see that it was the steepest and fastest run up in rates. And many people thought that that alone would throw us into recession. But we're not quite there. And now we sit on the precipice again of this Federal Reserve meeting and wanting to watch what they're going to do. And we're going to be looking very carefully at their expectations. And they will give us a piece of information called the dot plot, and that's depicted on the right-hand side of the screen. And that's where we'll be able to assess not just the median dot, but where other folks on the committee are thinking. And we'll very much be looking at that long-term dot, because what we want to see is if what the market is priced for and expecting is what the Fed is going to give us. So this is going to be incredibly informative as we move through the next week, because right now the market has priced in probably 240 to 250 basis points, or 2.5% of easing or rate cuts by the Federal Reserve over the next 2 years, which is pretty extraordinary and would take their rate down to round about 3% or so. We do think that Fed funds have peaked for the cycle, and that's important for considering your fixed income portfolio and investments and where you want to go. We do know that extending duration when the Fed pauses does provide an advantage. And I'm going to slow down on this slide. I've been ticking along here at a pretty good clip, but I want to rest here for a couple of minutes, because in fixed income, we often speak about duration, which is a measure of risk. Most specifically, it is how an instrument or a portfolio responds to changes in interest rates. And in that calculation incorporates time to maturity, right? Because again, there's more risk in loaning for a longer amount of time. But there's also an element of how quickly you make that money back. So it's somewhat inverted. A instrument that has a higher coupon rate would have a slightly lower duration for relative to an instrument with the same maturity or tenor that has a lower coupon. And that's simply because you're going to get your money back faster as you're collecting that interest. But when we talk about duration here, in this example in particular, we're looking at 3 areas. The darkest line is, again, that Fed funds rate. So to check that for you, you can see to the far right, that's hovering just at about 5.5%. And then the brighter blue or turquoise line is the Bloomberg US Aggregate Bond Index. And that is comprised of a broad swath of fixed income securities. It's roughly 30% US Treasury bonds, and that's across the whole curve up to 30 years. Corporate bonds, those would be high-grade bonds akin to the names you would know from the S&P 500. And then mortgage-backed securities. There's also smaller weightings in there for high yield and other asset classes. So then we're comparing that broad long bond market to a taxable money fund average that's produced by a group called iMoneyNet. So you can see that if we look toward the far right, all of those lines are kind of fighting one another. But when the Fed is on pause and when rates are declining, the blue line, turquoise, the US Ag, clearly lives above those other areas and can offer more in terms of yield. But let's take a look back at another time when the Fed actually did produce a soft landing and what happened in the market at that time. So again, here, the darker blue line is a proxy for deposits or liquidity or CDs. It's the 3-month T-bill. And then we go out in terms of maturity, the 2-year US Treasury, the 5-year in gray, and the 10-year in purple. So this is how rates moved before and after that rate cut in mid-July of 1995. But let's scale that move. Okay, so what we have here now on the left is the cumulative rate changes and then the total return if you had invested in that pure instrument over that 1-year period. And the lesson here is that the shortest rate kind of holds around 6%, right? It stays where it was. But then as we go out in terms of maturity, the opportunity for return becomes more robust. I'm going to take us back. When we're thinking about total return and what's available to us, it's about income and price changes. And those combined together give us total return. Now, money funds and certificates of deposits and rates that were paid on our savings, they're only going to give us yield. There is no optionality there. There's yield only. The yield equals the total return. But as we edge out into fixed income, into longer maturity instruments and instruments of different types, we have the opportunity for a price return. The tricky part here in fixed income is that it's an inverse relationship. So when interest rates go down, the price goes up. So with the Fed about to be on the move, it's creating a great recipe where we have nice high income potential coupled with the possibility of price return to yield a greater total return. Looking at this, let's put the current fixed income yields in perspective. And these are dated as of June 30th for compliance purposes, but we can see the Treasury, this is an average again across the curve, 4.57% compared to June of 2020, early days of the pandemic at 0.5%, and then a 10-year average at just about 2.2. And that relationship holds as we go out to credit, which again is a proxy for the S&P 500, but expressed in bond land, investment grade credit. And then the aggregate, again, that's going to be a blend of roughly a third Treasury, a third credit, a third mortgage backs, and a couple of other areas sprinkled in. But you can see how you're getting that. And then as we move out the risk spectrum into high yield, almost 8% EM, and then municipal bonds, a very attractive asset class right now. And that 3.72% is unadjusted. That does not reflect the true return into your hand if we adjust for your personal tax rate. And when we think about fixed income, we discuss the yield curve. And that is simply if we take this upper left-hand example and look at the green, this is what I'm talking about. This is a normal yield curve where shorter rates, 0 years out to 5, are lower than those further out the curve. And you can see in most environments, remember the tech bubble of the early 2000s, the financial crisis, right? We've talked about 2008. I think I've mentioned that a couple of times because it's so notable in our recent financial history. And then sort of an odd situation, the COVID era, when policy came through so quickly and there were so many unknowns that the curve moved down in a parallel fashion, right? Rates just dropped across the curve. And that's part of that flight to safety trade as well. But here we are, June 30th on the bottom right, where the green line is June 30. The curve at that point in time was inverted, a non-normal relationship. And then the blue line is the December before. So what I'm expecting this time around, and this is what would create that favorable price movement in shorter term bonds, is that the curve now does a repeat of that top left-hand quadrant, that tech bubble. So in my vernacular, hockey's my favorite sport. So we're going to take this hockey stick and turn it So the toe faces down and it begins to drag. Another concept that we like to illustrate is, again, duration or interest rate risk. So this is a very simple mathematical exercise where we've stressed rates up 1% or down percent simply to show the potential impact on a portfolio. Now, again, this is a simplified example. We are not accounting for convexity on bonds. We're not accounting for credit spreads. And we're assuming that all points on the curve move the same direction, which I showed you is unlikely to happen. But the real story here, and to sum it up, is that if the yield or income available on the fund or index or market proxy exceeds that of the duration, your downside below zero or negative returns are somewhat limited. Again, there's all of those other factors that I mentioned that can distort this or shift the relationship. But in terms of interest rate movement from the Federal Reserve, this captures the intent. So if we look here at this US credit example, US credit 1 to 5 years, that is the fifth bar over. The yield to worst is about 4.8 and the effective duration is 2.6. So in the bar chart, if rates go down, they go in our favor, we add the two together, 4.8 plus 2.6, 7.4. If rates go up, which would work against us in terms of price action, we'd simply subtract the 2.6 from the 4.8 to get the 2.2. So again, pretty attractive risk return profile toward that front of the curve. I will say that I receive a number of questions on what's called the TLT. That's an ETF that trades the longer end of the US Treasury market. And that to me is more of a bet than an investment. Sorry to editorialize, but you can see the risk reward there is pretty astounding compared to what those of us in bond land are used to discussing. I'm going to give you a framework here, or really what I think of as almost a back of the envelope approach for how to value the fixed income market. And here I'm using the 10-year. That's my favorite rate. That's my proxy for the market. But you've also heard me say that I like the 1 to 5 year maturity better. But the 10-year is usually a pretty good way to weigh your options in fixed income. And what we've done is we've created a shorter term time horizon. We've expanded that now to anticipate this current Fed cycle. So we're taking the current Fed funds rate of 5.5%. We're adjusting toward where we think that the spread should be to the 10-year to the Fed funds rate. Then a little bit of normalization, and we're expecting about 2.5% of cuts in the cycle. So that gets us to about 3.5% as fair value. If we look out over the longer term time horizon, we take that Fed median dot, so that is subject to change next year. And then we add in the term premium, that's a historical factor, usually saying if the Fed is going to be at 2.75, we want about 1.5% over that to account for that risk in moving out to a 10-year. So that gives us a band of about 3.5 to 4.2% of when we think, treasuries are fairly valued. We are, right now have really been pushing lower on the 10-year, but I think after we get out of the fear of missing out trades that are perhaps in the market in the near term and get more information from the Federal Reserve next week, we could move out of that range. And then an area that I'm often asked questions about is, with fixed income, it's been positively correlated to equities. I think one of the tougher things with investing is to realize that when the world is working, it's all working and it's all humming along. But you want to be able to protect your portfolio from the downside. And it's just, again, you've heard this drumbeat or theme in my discussion that we haven't had a recession in a very long time. And it's really during a recession that bonds are on your side. But if we can look here, and what I'm doing here is looking at the S&P 500 returns, and then on the other axis, the Bloomberg US Ag. And I didn't look back to 1978 because it corresponded to 45 years. I'm at 1978 because that is the beginning of measurement of the aggregate bond index or the broader US bond market, moving into other sectors and away from purely just treasuries. So those areas in that top left corner, negative for equities, so that's a bad S&P year, but positive for bonds. Those circled areas are declared recessions. And then you can see most of the time over those 45 years, both exist in that upper right-hand corner. So that means that more often than not, we're living in a, pretty favorable world where things are good. Now, a time that most folks remember for bond land is the negative returns produced in 2022. And we can see what a spectacular and different time that was when the Fed was on the move aggressively to fight inflation. And that is the only time period over the 45 years, but both equities and bonds have produced negative results. I'll wrap it up here with a brief scenario discussion. What do we see in a soft landing? And we would characterize that as gradually declining inflation and a fairly resilient labor market. Feels a little bit about like where we are right now. So where you would want to be is, continue to extend in maturity and boost your income and total return potential. And then you can take some modest credit risk. If we're moving into a hard landing, that sort of rhetoric or equalizing the soft landing, that means recession. Okay. Boldly stated, hard landing is simply bad times in a recession. The Fed will likely act more aggressively. And that's all of the clues that the market is looking for right now. What does the Fed know that we don't? What is the data not revealing? Because all investors are always peering around that next corner, trying to ascertain what might develop. So here, longer maturity instruments would likely outperform shorter, and equity markets and riskier asset classes would likely have more heightened downside volatility. And then in a reacceleration, we've kind of seen that. That was broadly speaking the first quarter of this year. Recall that the Fed had stated in December that they pretty much thought that inflation was cooling off, and then the data surprised to the upside. So what we saw then was the yield curve remained deeply inverted, bond returns were muted, but equity and other riskier assets ripped. So, if I had to put sort of a percentage on each of those, I'm probably greater, this is me, not Federated Hermes investors. I think that the soft landing probably has fairly good odds now. If I had to cuff it, maybe 40%, hard landing, maybe 30, reacceleration 30. I might mute those last two up or down 5%, but I'd lean a little bit more towards soft landing now, but would remain, pretty nimble in my positioning and highly liquid because each employment report is going to give us more and more information. So with that, I'll conclude all of my prepared comments and invite my new friend Mo back to join us and to moderate for hopefully what is a spirited discussion of Q&A. Thank you.
We have a lot of questions. I don't know, my friend, if you want to take a drink of water. You've been talking for 35 minutes, but it's up to you.
Oh, well, thank you. I'm far too vain for that.
Okay.
Water on camera, but I do appreciate it.
No problem. All right. The first question we have is from Mason, I think it is. Bond fund ETF versus separate bonds. What makes better sense? Bond fund ETF versus separate bonds.
Separate bonds. I'm an advocate for professional management in bond fund land rather than selecting individual bonds yourself. I think that you get the broad theme of diversification and also credit research. But even more importantly, you get institutional access to bonds and the pricing in the market. So I would always advocate for a mutual fund or an ETF or a separately managed account, whatever vehicle works best for you. But the diversification provided in those instruments far outweighs the benefits of selecting your own bonds.
Thank you for that. And Angelo asks, since the treasury yield curve is currently pretty flat, how far out would you consider going to lock in current high yields?
Right. I really right now like the 1 to 5 year part of the curve. But again, that is not an evergreen recommendation. That is for this point in time. And I'm not trying to hedge, I'm simply trying to guide. We are going to learn more about how close we are to recession or not. And if that's going to be what our CIO of equities, who's very quotable, has deemed a small R recession versus a capital R recession, right? So 2008, the most recent recession on memory, was massive, right? A real reset and shift for our economy. It's possible that we might slowly grind here, in a way. But I like that 1 to 5 year part of the curve because I do think, particularly right now with valuations, that the 10-year and longer is a little bit mispriced once we get through the elections and then as folks start to contemplate the weight of the federal debt issue.
Thank
One
you
to
for
five.
sharing. Joseph asks, are stocks that pay consistent dividends an option instead of treasury bonds?
I love this question. I sit beside the dividend income team, so I hear them speaking all the time. I'd say it's a different way to perhaps get close to the same place. As a fixed income specialist, I would advocate for a more diversified approach to bond fund investing rather than pure treasuries. And I think that right now you can see that with more clarity than with the dividend payers. So I think rather than US Treasuries, get into a more diversified bond fund that can give you some credit exposure, some mortgage backs, and use that for income. And that way you're not taking on some of the volatility of those dividend payers.
Better be safe than sorry, right?
Right. Bird in hand, right?
Bird in hand, yep, absolutely. Kathy asked, is now a good time to buy long-term treasuries, even with the inverted yield curve?
I don't love the long end of the curve right now. And I showed you that risk return potential, which is extraordinary, right? Possibility of just on pure rate movement alone, getting upwards of 21% for holding a treasury bond, right? Sounds great. But if rates move against you, or we have political turmoil or policies, and again, I'm not here to fight about politics with anyone, but we could see a situation where the longer end part of the curve, which has been more resistant to making changes. And when I'm saying longer term, I'm going to define that as starting at 10, but the most extreme movement likely coming from the 30-year. I think that has the potential to push higher, which would work against you at this point in time. So again, 1 to 5 years is going to give you the highest yield now and the most possibility for the Fed action to be felt there. The front end of the curve, 1 to 5 years maturity, 0 to 5 years maturity, is going to reflect the words and actions of the Federal Reserve. As we get longer, the curve, say 7, 10, 20, 30 years, tries to be more predictive and incorporate risks, be they known and unknown. So it's not my favorite part of the curve right now.
Fair enough. Here's a long one. I don't know if
Okay.
you want to get your pen.
Yes, you saw me. You know me too well.
All right. So Paul asks, can you speak to the difference between CDs, U.S. Treasury Corporate, AAA, AA, A/A, BBB, Municipal, AAA/AAA, all caps, bonds in the good and bad, and investing them? And he says, thank you.
Oh, thank you. Okay. I'm going to recast that question in a little bit
Absolutely.
because I think what he's getting to is CD, certificate of deposit, right? A way that you invest your money at your local bank or with a provider, and you buy something that has a defined tenor and you know what interest rate you're going to get back. Your money is locked up for that time period. So there's give and take. Then we have corporate bonds, treasury bonds, and munis. And I think those capital letters after were denoting the nationally organized rating services, NRSROs, and that's Moody's, S&P, et cetera, Fitch. And they rate bonds broadly on a scale of AAA being the best, all the way down to single C or D. D means default. Okay, so a dividing line in our world is between triple B minus and above is considered high grade. Double B plus and below is considered high yield, speculative grade, lower credit quality. So let me go through those in turn. So with the CD, again, you're getting a defined rate of return, but your money is locked up. You're not liquid, right? You have to leave it there for that amount of time. I would always advocate for using a money market fund over a CD because you're getting a very attractive rate of return that reflects what the market is doing, but you have daily liquidity and no principal risk. So you can put your money in, and usually when they're quoting those rates, right now, if you're seeing a rate quoted of 5.25, that is over a full year, right? So if you had your money in for half of a year, you'd roughly get half of 5.25, but you have daily access to that cash, whereas the CD, you don't. So oftentimes those are listed at pretty promotional rates. I, for one, would always emphasize liquidity over getting that little bit more so that in times like this, when the market is, about to move around a corner, you have the flexibility to take advantage of what the market is doing. And then I'm going to discern between the treasury bonds. Those are instruments of the US government. So they no longer have the complete AAA, right? We've had some rating agency changes over the past couple of years or so that have moved them down a peg, but still it is the world's flight to quality market and really drives most of the market. Now, when we're talking about the 10-year, and that right now, looking at my notes here, is quoted at about 3.65%. And that's the base rate from which we derive all of the rest of our valuations. So if we lean out into the corporate bond market, if we look at a pretty average instrument, right, of reasonable credit risk in the 10-year space, say it's rated high triple B, so it's pretty fine credit quality. Right now, you're going to get about 100 basis points or 1% more. So if that price today, you'd get a coupon of 4.65%, but you would take on that corporate credit risk, right? Is that company going to continue to sell the things that it makes? Or to be a leader in the space? Are they going to continue to manage their balance sheet in accordance with being a high grade company? All of those things play into the assessment of credit risk and whether or not they can pay you back. When we dip down into high yield or below double B plus, you get a higher spread, right? You might get a couple of 100 basis points on that same instrument, but you're taking more risk because those companies definitely have problems of one way or the other. A fallen angel that at one point in time was investment grade may have had a business issue or taken on too much debt that they couldn't really pay back through a failed integration of poorly timed M&A, or they could be a smaller entity that's just trying to get its footing and needs to take on more debt in order to grow and develop its product and its product market. That would be like a really new business or something that was more cutting edge. But there you do get a little bit more of a premium. And then the muni market, priced a little bit differently. Again, you'll see those rates look ostensibly lower because of the tax exemption. So you're going to take what you're getting on a muni security, and then you're going to gross it up by dividing it by your tax rate to get an estimate as to what your yield is. Now, long questions get long answers, if you'll forgive me, Mo. I'm going to dig in here
Please,
a little
I'm
bit more.
enjoying this.
Oh, good. Dig in a little bit more here on valuation. So higher grade credit, we think is in pretty good stead right now. Spreads, again, that measurement of the valuation, how much more you're getting on that instrument relative to its corresponding US Treasury by maturity. Those are relatively tight compared to historical averages, but again, we see pretty strong balance sheets across that complex and pretty solid financial operations. Revenues are good, expenses are being managed, so margins are coming in better than expected. And again, a proxy for that, typical names would be in the S&P 500 that would correspond. As we dig down into high yield, which is a market that investors love and love to talk about, and the only thing I can think about is that it's so much closer to equity land, right? The risk reward is much, much higher in high yield. But what we're seeing is that high yield spreads are historically very, very tight, and where we can actually put money to work. So the average is, roughly speaking here, this is economist math, not CPA math, roughly about 350 basis points right now. But we can't invest at that 350 because that's across a whole index that includes bonds priced at $30 that nobody thinks is going to be able to repay. So we would really cuff that in an actionable median at about 300. And I think that this bears mentioning right now. There's a equity strategist at Schwab that has stated the analysis of averages yields average results. So you see from time to time here, I dig into medians to peel back that onion to more meaningful statistic. And I do think that that's very, very important right now. And even as you consider headlines, right, and teasers, always kind of dig below to the rest of the message. But so median there is about 300. And when you think about 300 over the corresponding treasury compared to what you can get in a money fund right now, they're almost equalish. Doesn't make sense, right? Overnight lending versus a high yield company. So that's an area of the market that we've turned a little bit less optimistic on. We think it's fine to have a weighting there and a strategic view on high yield, but would definitely be underweight in your portfolios at this time. And then munis, I started out in munis. I always have a soft spot for that market. In this time of political turmoil and unknowns, there is a possibility that some of the tax cuts sunset and don't come back. So with the specter of higher taxes, I think it is really good to take a look at tax exempt investing and to consider a place for municipals at any spot in your investment portfolio. I know that the savers enjoyed getting greater than 5% on their savings. I think because it had been so very long, many of us forgot that that came with a tax bill. So looking at tax exempt options in that space is a good way to mitigate that tax bill.
Excellent. And thank you too, Paul, for asking that question. What an amazing breakdown. Thank you so much, Karen.
Oh.
All right. Michelle asks, do annuities fit into fixed income portfolio strategy?
They can. I would reserve, getting into detail on that with your financial advisor. It's very specific to an individual's situations, risk tolerances, cash needs, and kind of all out the line as to how you would consider an annuity in your portfolio.
Yeah, that's definitely fair. Thank you. Joel asks, I hear bonds are priced for perfection, but with rate cuts coming, I expect decent gains. What is a person to do?
Terrific question, because we are at this great precipice of change. And in the very short run, over the past couple of weeks, we have seen people piling into bonds. And I think yields, again, on the longer part of the curve are somewhat temporarily a little bit lower than they should be. But I'm talking in shades of gray, in those shades of gray approaching white from like a day-to-day practitioner and somebody that's looking at rates minute to minute. I would counter, I love my equity brethren, but if bonds are priced to perfection, equities are very much priced to perfection. So I would consider your portfolio allocations. And I also would take a keen eye in two areas of liquidity. Number one, how much liquidity do you need? What cash do you need over the next 12, 18, 24 months, whatever makes sense for your stage of life, and for your lifestyle, business, and other needs, right? Like I, for example, have kids in college. So my cash outlays are tremendous at this stage in life. Another couple of years, right? I'll get past that and can keep, a little bit less in cash on hand as I start to stash away more and more for retirement. So those are the kind of things that I'm talking about. But think about your cash needs and where you need to be. And then whittle that down to a reasonable amount, but respect that over the next period, as the Fed gets on the move, you will get a better return out of fixed income and equities. And your balance there, again, is going to reflect your risk tolerances, your needs, and where you are. But also, depending on your investments, I would keep an eye on using liquid instruments. It does not make sense to me to pay higher fees for more esoteric investments, right? 10 years ago, we very much had to stretch for yield and may have been willing to give up some liquidity. But now, with where yields are in fixed income and with what equities are doing, I don't think that there's a need for any esoteric instruments. And I would even say that across some very high net worth portfolios, it's just something I would suggest taking a look at. So, two sides of liquidity, keeping your investments liquid and then looking at your cash to ascertain what do you really need in that cash and very liquid part.
I chuckle when I see the titles on Google. I have this much money, can I retire at 59? But like you just explained, there's just so much, that you have to really think about. And you don't know how much debt you have. And, so excellent,
Right.
excellent explanation.
Thank you.
All right. Couple more.
Sure. I'm
All
game
right.
if you are.
I'm definitely game. Jacques asks, can you discuss reinflation risk versus duration risk? Reinflation risk versus duration risk.
Sure. Another super good one. I love this audience. So, reinflation would suggest that inflation, right, which we think is moving toward the Fed's target of 2%, so coming down, would cease, and that we would begin to fight inflation again. So, what it's saying is that the year over year number is 2.5% rather than staying at 2.5% or trending lower, that it would reinflate or start to move up again. So prices broadly go higher, wages are pressured, and there's many dynamics that could support that. It's my view that that dynamic is tempered, right, by supply and demand. Other factors contract that will keep a lid on it. Again, I don't see inflation sitting at sub 2%. Recall after the great financial crisis, the Fed couldn't get inflation over 2%. And that has different issues. But in the case of bond investing, inflation is harmful, extraordinarily harmful, because you're striking a contract at a specific coupon rate or interest rate. And if inflation comes back and rates increase, that means that your investment, isn't going to do as well, because if you had waited and loaned somebody money, you could have done it at a higher rate. So balancing out those two factors is extraordinarily important. So I'll take them in turn. Again, inflation, it's not going to be as low as it was in the prior decade. But again, I think that there's enough forces to keep it relatively balanced. But that's why with duration, I suggest being fairly measured here. Again, focused on that 1 to 5 year maturity in the near term. I do think in terms of a duration target or anchor on personal portfolios, I do ultimately like 6 years. which is about the duration of the Bloomberg US Aggregate Bond Index. I
Oh,
think that again is a very good anchor. If you're looking directionally for what is going to get you the highest potential return, in my view, at this point in time, it's that 1 to 5 year part of the curve and high quality. But I don't advocate for individual investors being longer than 6 years as a general rule of thumb.
fantastic. Karen, this was an amazing educational hour. Thank you so much for being here. We so appreciate it. And your team was fantastic as well.
Oh, thank you, Mo. You have kept me at ease. It's been a
Oh,
smooth operation, and
um,
I've enjoyed my time with you. So,
so have I. Thank you again. And thanks to all of you for joining today. We know your time is valuable. Make sure you let us know your thoughts on this webinar in the Q&A tool. And as a reminder, we have several other webinars at www.fidelity.com/webinar. We look forward to seeing you again. Until then, stay safe.